This is China Gateway 360. China's green bond rules just got stricter. What does this mean for foreign investors?
Let's look at the market landscape. We're talking about the world's largest green bond market. Cumulative issuance hit a staggering 4.2 trillion RMB by the end of 2023. That is roughly 580 billion US dollars. But if you look closely, there's a massive disconnect. A full 89% of these bonds are held by domestic institutions, while foreign ownership sits at just 1.8%, which is actually down from 2.1% in 2020. Historically, this systemic friction has kept foreign capital on the sidelines, mostly due to structural fragmentation and real greenwashing concerns. Well, the 2024 standards review we're breaking down today is designed specifically to fix that gap.
To really grasp the impact of these 2024 standards, we need to trace the regulatory timeline. Before 2021, the standards were so fragmented that, believe it or not, coal was actually allowed in green portfolios. But the 2024 rules completely changed the game. Now they require 100% of net proceeds to be backed by green assets. And this is absolutely crucial for ESG mandates. We're seeing the total exclusion of all fossil fuels. Yes, that includes natural gas. Plus, there's a major shift happening right now from voluntary annual reporting to mandatory quarterly impact reporting. As we dive into the details, you'll see this review is built on 3 core pillars. First up, a unified taxonomy. This directly cuts due diligence costs for foreign investors by up to 40%. Second, proceeds allocation is now strictly capped at a 12-month deployment window. This is a massive operational shift. For context, a 2023 audit revealed that 14% of previous Chinese green bonds had proceeds just sitting idle beyond 24 months. This closes that loophole entirely. And finally, mandatory verification. This forces immediate transparency into the market.
Now, when we benchmark China against the EU and ASEAN frameworks, a really interesting dynamic emerges. On paper, China's new rules are actually stricter than the EU's when it comes to fossil fuel exclusions and proceeds allocation timelines. However, as an investor, you have to watch out for the operational friction. Right now, third-party verifiers' accreditation is restricted entirely to domestic bodies. There are only 14 authorized firms in China, and currently 0 European or US firms are approved. So foreign investors are effectively forced to navigate these domestic compliance networks.
China Gateway. Gateway.
Your gateway to business in China.
So how do you actually allocate your portfolio? We've mapped out 3 strategic pathways. If your primary goal is yield optimization alongside risk control, state-owned bank financial bonds that meet this new 100% rule are highly attractive right now. Looking at the Q1 data, Chinese green AAA-rated bonds are yielding an average of 3.2%. Compare that to just 2.1% for equivalent EU green bonds. And you're getting that yield with an ultra-low default risk of just 0.08%. But of course, with these opportunities comes strict implementation risks as outlined in this diagnostic playbook. One critical pitfall to avoid is overlooking those new quarterly reporting start dates. If you manage an EU-based fund, failing to secure timely impact data means you simply cannot prove regulatory compliance under the SFDR. That specific compliance failure risks fines of up to 5% of your total assets under management. The fix is straightforward, though. You'll want to restrict your purchases to leading adopters who have already published at least one quarterly report prior to the January 2025 mandate.
The good news we're seeing in these Q1 2024 market trends is that adoption is already accelerating fast. In just the first quarter, issuance hit 320 billion RMB. But more importantly, 96% of those Q1 issuances voluntarily adopted these strict standards early. That shows massive underwriter buy-in. And to bypass some of the existing capital account restrictions, we're seeing foreign capital increasingly utilize secondary market overlays. This has driven a solid 34% growth in green bond ETF assets over the last year, giving you a much more accessible entry point.
All right, so what is the immediate action plan for portfolio managers? It's a straightforward 3-step process. First, map your existing holdings against the 2024 standard. You need to weed out any pre-2021 issuances that lack full alignment. Second, engage one of those 14 accredited domestic verifiers we talked about to secure dual certification for your future purchases. And step 3, aggressively screen the market. Build a strict 5-factor watch list that tracks everything from taxonomy alignment to reporting discipline and certification status. Ultimately, the 2024 review is a gateway, not an endpoint. By decisively unifying these standards, China has drastically reduced the information asymmetry that historically kept foreign capital on the sidelines. Early adopters who navigate these verification nuances today are perfectly positioned to secure a real first-mover yield advantage. Want the full compliance guide? Like, comment green, and get the guide.